The Dow jumped 955 points Tuesday on signals that the Iran war could end, while Brent crude climbed to $120 a barrel on the same day. Both things happened simultaneously. That contradiction is the entire story. Trump told the New York Post the U.S. is not going to be there too much longer, and unconfirmed reports on Tehran suggested Iran's President Pezeshkian was open to a deal. Markets priced in peace. The S&P 500 rose 2.4%, Nasdaq surged 3.3%, and tech names led. Meta up 6.5%, Alphabet up 4.8%, Nvidia up nearly 5%. But the mechanism that caused the war's economic damage, the Strait of Hormuz closure, remains intact. 1/5 of global oil supply still cannot flow normally. Brent's climb to $120 reflects that physical reality, even as equity markets priced in a political signal. JP Morgan's Jamie Dimon said the U.S. must finish this thing and clean up the straits, warning that a withdrawal without reopening the waterway leaves the global economy permanently exposed. Signum Global advisors called it extremely unlikely that Trump would leave without at least attempting to reopen the strait by force or diplomacy. The risk is a split outcome. Equities celebrate an exit, while energy markets stay elevated because the bottleneck endures. If Pezeshkian's reported openness translates into a verified ceasefire with Hormuz terms, the rally has legs. If it stalls, as similar signals have before, the month-end pension rebalancing that amplified Tuesday's gains will not repeat, and the market gets the de-escalation premium without the underlying cause. That same energy shock creating the war rally is also quietly trapping the Federal Reserve. Oil above $100 for multiple consecutive days is the textbook trigger for rate hikes, but Fed Chair Powell signaled Monday he intends to look through it. By the time the effects of tightening take effect, the oil price shock is probably long gone, he said, invoking the standard supply shock doctrine. The problem is that this shock is not standard. WTI crossed $100 on a geopolitical closure with no confirmed end date, not a temporary disruption. The 10-year Treasury yield climbed from 3.97% in late February to 4.44% by late March, a 47 basis point move in 5 weeks. The bond market is not fully accepting Powell's look-through thesis. Regular unleaded gas hit $4 nationally for the first time since 2022, and the OECD raised its U.S. inflation forecast to 4.2% for 2026. Kansas City Fed President Schmid warned Tuesday that inflation could get stuck close to 3%, a direct challenge to the transitory framing. The Fed's paralysis has a structural explanation. Rate hikes would arrive after the oil shock has already run its course, compressing an economy already facing softening job openings and falling consumer confidence. But inaction carries its own cost. If inflation expectations become unanchored, the Fed loses its primary defense without having fired a shot. The bond market's 5-year versus 10-year break-even spread suggests the crowd still believes the shock will be short-lived. That anchor holds only as long as the war's duration remains bounded. A ceasefire within weeks validates Powell's patience. A war that extends into May begins to make Schmid's 3% scenario the base.
While the macro debate consumed headlines, Nvidia made a move that quietly reorganizes the AI chip supply chain. The company announced a $2 billion strategic investment in Marvell technology and a partnership integrating Marvell's custom silicon into the NVLink Fusion ecosystem. Marvell stock surged as much as 12% on the news. The deal's significance goes beyond the capital. NVLink Fusion allows third-party chips, in this case Marvell's custom XPUs, to connect directly to Nvidia's AI infrastructure as first-class components. For hyperscalers building AI factories, that means they can deploy Marvell's application-specific processors alongside Nvidia GPUs without losing ecosystem coherence. Marvell's fiscal 2026 data center revenue hit $1.518 billion in Q3, representing 73%